Let's start, friends, with portfolio management. Let's try to understand what exactly is portfolio management. First, portfolio, what exactly is portfolio? Portfolio is nothing else a bundle of securities, different securities having different return and risk characteristics. A portfolio may consist of 5 different variety of shares, or shares and debentures, or debentures in FD. So all these different types of securities having different risk and return characteristics, they all are combined in a bundle, and that bundle is known as portfolio. We are trying in this portfolio management to maximize the return and minimize the risk from the portfolio so as to achieve ultimate wealth maximization. So what is return and risk from a security? Return. Friends, the return computation in finance is little different from the computation of return in accounting and other subjects. Here, price appreciation of the security, the market price appreciation is also a part of return. As I clearly mentioned, the return has two components. One is the market price appreciation and another is dividend. So, this is one component which is the major component of return. So normally what happens, if I purchased a share for P100 and the market price has gone up to 110, normally we say that unless we sell the shares, we don't have any return. The answer is no. In finance, if the market price has gone up from 100 to 110, then 10% is the return that we have earned. Over and above, if you have earned 5% as dividend, then the entire return will be 15%, 10% for market price appreciation, plus 5% for dividend yield. We will break this part into components and then we say how to compute the return. This part and this part we are segregating, so we can say return for the period T is equal to PT minus 1 divided by PT minus 1 into 100 plus dividend during the period divided by the opening price into 100. So we directly say it is market price appreciation percentage plus dividend yield percentage. So return has two components, the appreciation percentage during the period, where PT is the closing price, PT minus 1 is the opening price, divided by the opening price to 100, plus the dividend yield, that gives you the return in percentage terms. So as compared to the normal belief, in finance, we even take the appreciation in price as the return, including dividend. So what we have done basically is the computation of return for the period T, which has two components. One is market price appreciation, another is dividend yield. Next, this way we can compute return for all the periods. Then we say expected return or mean return. Mean return, which is equal to say R bar. R bar will be the average of return computed for different periods. The average of return computed for different periods. So it is R1 plus R2 plus Rn divided by n is R bar. So R bar is R1 plus R2 plus R3 plus Rn divided by n. Then we need to measure risk. How do we measure risk? Risk implies nothing else but fluctuation of returns. Fluctuation of returns from its mean. Basically, if the return is fluctuating, up and low, then we say the risk is too high. If the fluctuation is too high, the answer, the risk is too high. If the fluctuation return is low, it's not very wide enough, then we say the risk is also low. So which is measured as variance. Risk is measured in terms of variance, which we call it as sigma square, which is equal to summation of Ri minus R bar whole square divided by N. If I expand it further, it can be like R1 minus R bar whole square plus R2 minus R bar whole square plus whole divided by N, which we can write in the summation form as Ri minus R bar whole square upon N. You all have read at your school level about in the statistics about the sigma square, where we say the summation of xi minus x bar whole square divided by N. In some of the books you may find they divide it by N, but our institute has already accepted that it has to be divided by N, and even by N minus 1 will be taken as correct. So in some books we find the answers as this, RT minus R bar whole square divided by N minus 1, then both the answers are taken as correct. This is on the assumption that the population data we are dealing with, and this is on the assumptions the data we are dealing is the sample data, and so divide by N minus 1. But for our computation, we in our class will take it as divide by N only and not this, although this is equally correct as well. We go ahead to question number 1, where we need to compute the return and risk. Question number 1. Jensen and Nicholson. Question number 1. Here, different years are given from 1987, but we can say return for the year 1987 cannot be computed. Cannot be computed. The reason is very simple. Because the base year information, the market price per share for the previous year not given, so we are not able to compute the appreciation percentage for 1987. So we start with year 1988 onwards. Make it kind of table. Year 1988, 89, 90, 91 and 92. Then we compute return percentage for the concerned year. We call it as RT or RI in percentage. For RT, for the year 88, we compute the return as by saying the closing price given is 20.75 less the opening price 31.25 plus dividend of 1.53 divided by the opening price of 31.25 into 100. That gives the answers as minus 28.78%. So return for the year 1988 was negative minus 28.78%. Exactly the same way we can compute the return for the year 1989. For 89, it will be the closing price of 89, 30.88 less opening price. Dividend eventually is the same, divided by the opening price of 20.75 into 100. That gives us the return for the next year, which is 56.19%. Proceeding exactly the same way, we can find out the return for the third year, which of course is the part of your homework. Simply mechanical work I am skipping so that we can concentrate more on the concept part of it. It is 123.45%, then 52.24%, and then 57%. If you add it together, then summation of RT comes out to be approximately 260.18. Thereby we get the answers as R bar 260.18 divided by 5. The answer approximately is 52.03%. So we have computed the average return for the last 5 years based on the formula that we have discussed. The return percentage during the year is the change in the price appreciation plus dividend divided by the opening price, and that gives you the return percentage as this. Then comes the variance. For variance, we need to compute RT minus R bar whole square, then summing it up here, and then divide by n. So we already say we know the formula. It is RT minus R bar whole square divided by n. This is R bar, so it is minus 28.78 minus 52.03 whole square. Again similarly, 56.19 less 52.03 whole square. This way we go on adding up. All this, and finally we get is 11160 as the total. And then finally we compute sigma square, and so sigma square will be 11160 divided by 5, and this sigma square, which is a variance, is 11160 divided by 5. You all can calculate easily. If I make calculate for you, it is 11160 divided by 5 is 2332. And so sigma, which is standard deviation, is equal to 2332 square root of it. So it is 48.29. Make sure the unit of standard deviation is percentage. So you must not forget to write the percentage here. So we can say the risk of this security is 48.29%, or its variance is 2332. Both the answers are correct, but then we finally write the unit in standard deviation form, because standard deviation expressed in terms of percentage only, and interpretation of standard deviation is much easier than interpretation of variance. So finally, both the answer variance and standard deviation is correct, but still we write the answers in terms of standard deviation, and we say the risk of the security is 48.29%. Now you can very easily guess if the average return earned is 52.03%, and the deviation this side or this side is 48%. That means probably your return can go down to as low as 52 to 40 less 48, go down to as low as 4%, or can go up to 100%. That means fluctuation is large enough. And so we say the security is very risky. We say the security is highly risky. In fact, in general, whenever standard deviation is more than 15 or 20%, we say the shares is very risky. That's thumb rule, that if shares return risk is more than 20%. In general, as I said to you, if sigma is more than 20%, we say the shares is a very risky share. The fluctuation of return around its mean, is highly fluctuating in both the directions, making a total of 48.29%, which is much more than 20%, and the shares extremely highly risky. This way we are through with this question number 1. Let's go ahead with question number 2 onwards. So friends, what we have discussed was the computation of return and risk for a single security. Computation of return and risk for a single security. Now, but as I said you, the portfolio is a bundle of many securities. So we need to find out the return and risk for the portfolio and not just for a single security. So let's start with the simplest portfolio of just 2 securities. Let's go ahead. So we start with portfolio of 2 securities. Let's say we call this security number 1, security number 2. The return here for security 1 is R1, return here is R2. The standard deviation, this is percentage, it's also in percentage, is sigma 1 and sigma 2. And the weight, because it's a portfolio, so weights of security is say W1 and W2. For example, if you invest 40% in security 1, say Reliance, and 60% security 2, say Tisco, then it is 0.4 and 0.6. And naturally, the sum of the weight has to be 1. So first we are through with return, standard deviation, weights. Then we say the correlation coefficient between the returns of the 2 securities is R12. So correlation coefficient between the returns of 2 securities 1 and 2 together is R12. So this is return, standard deviation, weights, correlation coefficient. Now what we need to do is to find out RP. RP is nothing else but return from portfolio. Return from portfolio consisting of 2 securities is nothing else but their weighted average. And similarly, the sigma p square, which is the variance of portfolio, as per statistics, the formula goes like this. It is W1 square, sigma 1 square, W2 square, sigma 2 square, plus 2 W1, W2, R12, sigma 1, sigma 2. There is nothing great difficulty in remembering the formula. It is W1 sigma 1 whole square, W2 sigma 2 whole square, and then W1, W2, R12 additional term is here. R12 represents the correlation coefficient between the returns of the 2 securities, and this becomes a formula situation. We go ahead with question number 2. In fact, we can write down the data here itself so that you understand it better. Question number 2, with the same notation that we are using, say R1 is security X and 2 security is Y. Then R1 is 24%, sigma 1 is 28%, R2 is 19%, sigma 2 is 23%, and given in the first line itself 2 equity shares in equal proportions. So by equal proportion we mean the weights are equal. Given also that they have a positive correlation of 0.6, so it is 0.6. This is one question that I am going in details. Next question onwards, the mechanical calculations will be skipped in the class, and that has to be done as a part of your homework. So W1R1 will be 0.5 into 24 plus 0.5 into 19. That gives the answers to be 21.5 in terms of percentage. Similarly, the variance will be 0.5 square, sigma 1 square, which is 28 square, 0.5 square, sigma 2 is 23 square, this is equal to 521.45, and so sigma p will be equal to square root of 521.45, which is equal to 22.84. As I said you, standard deviation has a unit of percentage. So variance of portfolio is this. Take the square root to get the answers after speed. So we have two securities, 1 and 2, and if I combine together in the equal proportion, then the return from portfolio is 21.5%, and the standard deviation of the portfolio, P stands for portfolio, is 22.84%. So it's just a direct application of the formulas taken from the statistics. Nothing needed at all. Simple calculations can help us to achieve good marks easily. Question number 2 is over. We go ahead with question number 3. Question number 3.